Hello and welcome to this Vinva Funds Update. My name is Mark Jordan from Magellan Investment Partners. Today I'm joined by Steve Malin and Nick Burt, both portfolio managers from Vinva. Welcome, gents.
Thanks, Mark.
Thanks, Mark.
Perhaps first question to you, Steve, and probably starting with global equities. Can you give us an update on how the strategies have performed over the past quarter?
Yep, certainly. So just on global equities in general, it's been a pretty strong year so far. Global markets on the beta side of the equation are up around sort of 15%, with roughly half of that coming in the last quarter. Feels like a far cry from early April, and the bounce back has been pretty spectacular, up over 30% since the lows. A little bit more modest in Australia, but still a strong year here domestically. And the really nice thing for us is the bit that we control, the alpha component, the active component, has also been positive. So Vinva strategies have outperformed across the board, both here and overseas.
And where did that outperformance come from?
Yeah, good question. As is typical of a Vinva portfolio, it's a very broad portfolio, so you're getting outperformance from lots of different little pockets. The pleasing thing for us was that internationally, all three of the major regions were good sources of outperformance for us. So Americas, Europe, and Asia, and also across the whole cap spectrum. So the large caps, mid caps, and the small caps were all profitable for us. A couple of segments that sort of stand out worth mentioning. One is gold. Gold price has been on a huge tear, as many people are aware. We have had some overweight positions in that subsector, particularly in Canada. So Canadian gold stocks, Kinross was one. Also North America, Newmont is probably a stock which is familiar to a lot of Aussie investors. Took over Newcrest a couple of years ago. That's another one that did well for us. And also locally here with Regis Resources. So that whole segment has done well. The AI theme is obviously a big one, and we tended not to play the AI theme through the mega caps. So further down that cap spectrum, a company called Celestica. It's a Canadian listed tech stock, makes components and happens to have a certain open AI as one of its major customers, and the market reacted very positively to the suggestion that they may make another 2-3 billion in revenue next year on the back of that. That's been a strong one for us. Locally, it was much more about reporting season. Obviously, plenty going on. I'll probably let Nick go into a little bit more detail on that one.
And to you, Nick, recent reporting season showed some wide dispersions in results, with both long and short positions producing varied outcomes. Could you share where shorting worked particularly well, or conversely where on the long side it worked?
Yeah, absolutely. As you mentioned, it was quite a volatile reporting season. It wasn't uncommon to see a stock up 20% or down 20% on the day. Having said that, when you look at our portfolio, it was relatively subdued sort of performance throughout the reporting season. I think that lends and sort of demonstrates, I guess, the nature of the way we manage portfolios. We try and eliminate a lot of that stock-specific risk by actually taking a lot of smaller sort of active positions rather than very large sort of positions. So overall, despite all that volatility during the reporting season, we had pretty subdued performance. Overall, for the quarter, we did do very well. Our alpha extension strategy was up about 1.8% alpha over that period. And for the long-only strategy was up about 2.1%. So that actually does highlight something. When you actually see our long-only strategy outperform our alpha extension strategy, which has shorting and a higher risk budget, did indicate that on the short side, we did suffer a little bit more where we could take larger overweight positions. Particularly when you narrow down to where that actually occurred was mainly in the materials sector, particularly sort of the lithium, resources and uranium stocks. Lynas, Pilbara and Mineral Resources really had strong performances, and they were sort of large underweight positions. And in our alpha extension strategy, we actually shorted those stocks. That cost us quite a bit of performance relative to our long-only positions, which obviously can only go underweight the benchmark position. In terms of the overall signals, it did well during this period. And it's pretty much a continuation of the theme we've seen all year, where our behavioural buckets and also our linkage models have done extremely well. over the reporting season. Actually, quality and relative value was mild detractors, but it was more than made up with basically behavioural linkage signals.
Reporting season revealed that investor sentiment likely influenced some of the returns. How did Vinva navigate that period from a sentiment perspective?
Yeah, I mean, we don't really treat reporting season any different to any other period from a process and approach. It was fairly volatile. There were some big moves in some big stocks. But from our side, it's really about sort of sticking to that discipline, crunching the numbers, being true to our process. So we've spent the last 20 years or so building a process which is looking to be immune to those emotional decisions, and that's a big part of what we do. In fact, go a little bit further than that and say, in some cases, we're looking to exploit that emotion that can occur in markets. So, reporting season is an opportunity to do that, and it was very pleasing that we came through this particular reporting season really very solidly.
Nick, there seems to be growing momentum behind quantitative, systematic, data-driven strategies. Yet more information doesn't always translate into better returns for investors. As an active manager, how do you guard against data bias, and how do you combine analytical models with human insights to deliver, good outcomes for investors?
It's a very good point. Over 90% of the data has just arrived in the last couple of years, and that's still growing exponentially. Most of that data is actually unstructured data, so it's in quite a sort of messy format, which presents a lot of its challenges itself. So you mentioned at the start that more information doesn't necessarily mean more returns, and that's very true. More information can actually end up in sort of information overload and not knowing which data is relevant and which data isn't relevant. More importantly, the more data that you have, or the more information you have, particularly the more unstructured data, the higher the amount of the noise to the actual signal ratio is. And that requires specific techniques to actually extract the information from that data and also remove any biases. So, for example, if you look at company CEOs, they've actually been trained in actually how to speak basically at the conference calls. So there's an inherent bias in that underlying data. So you need to know how to actually extract that and actually look for more nuanced approaches to pull out the sentiment of things like transcripts. The other point you mentioned in terms of information and the excess amount of information is the more information you have, the more chance you could actually, incorporate some behavioural biases into your portfolio. So, for example, if you have a lot of human overlay, you'll be able to find some information that will basically give you some confirmation to your underlying sort of view. And it's what we sort of call a confirmation bias. So if you look, for example, at CNN and Fox News, when they report on the same economic data, they come out with two totally opposite views. They're not incorrect, but they're just selectively picking which data supports their view, and that's confirmation bias. So it's very important when you have all this additional information that you're stripping out things like confirmation bias from that, and that's what our process does. As Steve said, it's a process that's been built over sort of 30 plus years, and it takes basically discipline over emotion. You're trying to remove that emotion out of the process, and that's by getting basically a repeatable investment sort of process. And I can tell you over the last sort of 30 years sort of managing money, when you look at sort of our best trades, they're often the ones that I personally feel most uncomfortable with. So emotionally, I'm thinking, why are we buying this particular stock? But they're the ones that actually end up being sort of the best trades, where we're actually applying discipline over that emotion.
Thanks, Steve. Thanks, Nick.
Thanks, Mark.
And thank you for watching. If you would like to find out more about Vinva funds, please get in contact with Magellan Investment Partners. And as always, if you would like to share this video with clients or colleagues, please feel free. Thank you.